It's a new year, and we all know what that means. We've got new IRS tax brackets and also new rules. Yay! So in today's video, I want to share with you what this means for retirees. So let's jump in. Let's go to the IRS website directly to get this from them. The website is irs.gov. If you want to look this up and get more detail, it's the IR 2024-273. Okay, and again, this is directly from the IRS, and this report is labeled Notable Changes for Tax Year 2025. And I took out of this report the things that I think you need to know. So we're going to talk about what's changing, what's staying the same, and then more importantly, what this means for all of us. If you're getting close to retirement, if you're in retirement, what do these changes mean? So let's jump in. The first one that I think is really important is the estate tax credit. Now, I'm not an attorney, but in general, what this means is this is the amount you can pass to your heirs at death and not have to pay estate tax. Again, check with an attorney. But you can see it's almost $14 million. Estates of descendants who died during 2025 will have a basic exclusion amount of $13,990,000, which is an increase of over $300,000. The old limit was $13,610 for estates of descendants who died in 2024. That's a big difference. Now, a lot of folks have complicated estate plans because they're trying to avoid paying estate tax, which I don't. We need to pay the tax that we need to pay, but we don't need to pay $1 more than that. But you can see that's a very substantial amount of money. So um, take on no more complexity than what you need to achieve your goals. Okay, so that's what happens when you die. But we can also gift money to people that we care about, to causes that we care about, without paying tax. And the annual exclusion for gifts increased to $19,000 this year, a rise of $1,000. Last year was $18,000. So what does that mean? That means if you want to give to one of your children $19,000, you can. And neither you nor your child is gonna pay tax on that. And if your spouse wants if you're married, if your spouse wants to do that, your spouse can do that for your kids as well. So for a married couple, they can pass on $38,000 a year to their kids. Now, not only am I not an attorney, but I'm not an accountant, so check all of this with your accountant. None of this is financial advice. I just wanna share with you, what these numbers are. So you can pass quite a bit of money, to people that you care about without having to pay tax. And I see people with very complicated estate plans, and oftentimes they don't need them. They can be really powerful for people that need that to minimize the estate tax that they're going to pay. But the vast majority of us watching are not going to have to worry about this. Okay, what about our standard deduction? For single taxpayers and married taxpayers, the deduction rises to $15,000 for 2025, which is an increase of $400. And for married couples filing jointly, it rises to $30,000, an increase of $800. Okay, that's a lot of money. So the US has 7 tax brackets. We're going to get to those brackets in a minute. But the reality is we really have 8 tax brackets, and that's what the standard exemption is. Again, not an accountant, but you can make that amount and then you deduct the taxes, and most people are going to pay very little, if any, tax on the amount below the standard deduction. Okay, let's keep going. Marginal tax rates. Here, you can pause the video if you want to look at it. I have a table coming up in just a few minutes that'll show it. Same thing for the earned income tax credit. Okay, so to get a format that's easier for all of us to understand, we're leaving the IRS website now. We're going to the website of the Tax Foundation, and we're going to talk about, we mentioned briefly the income tax rates. We're going to see that in a table here in a second. But first, I want to talk about capital gains, long-term capital gains. So if you own a stock for over a year, these are the rates that are going to apply to the gains on it. And also if it's a qualified dividend. Again, talk to an accountant. I'm going to jump into a bunch of this and share with you why it makes sense, likely for many retirees to have an accountant. But let's go through these. So for married individuals, you can pause this and see the other categories. You can see people pay zero tax up to $96,700 in long-term capital gains and or dividends. And then that rate stays at 15%. It jumps to 20% for people that have over $600,000 of long-term capital gains and dividend taxes. Okay, now let's go to, so the U.S. has two basic income taxes. One is for the capital gains, and the other is for ordinary income. That's what this is here. You can see there's 7 categories here. What we don't see is the 0% rate, okay? So this is 0, it's a 10% tax rate from 0 to 23,850, but this is after the standard deduction has been taken. So you can see we've got the 10% tax bracket and the 12, and then importantly, it jumps. There is no 14, 16, 18, and 20. It goes from 12% to 22%. Now, we're going to want to remember that because it becomes important later. And then we go 22% to 24, and then there's another big jump to 32%. Okay, and you can pause the video to look at what it is. Here too is what the earned income tax credit is going to be. You can pause the video to look at that, but I want to jump into what does this mean to all of us. So I showed you where the income tax rates jump from 12% to 22%, from 24%, I believe it was 32% was. And so the strategy for retirees is, for most people, we want to definitely fill up the bucket, if we will, the bucket where we're taxed at $0 and probably the bucket where we're taxed at 10% and 12%, those lower tax brackets. And we want to avoid having our money bump up to the 22%. So for many of us that are retired, or for people that will be retired, this is a strategy that's important. Whether you're in retirement, you're 10 months from retirement, or 10 years away from retirement. The reason it's important is if you're 10 years away, you can be thinking about, begin with the end in mind. Where do you want your money to be? So there's really 3 main buckets that allow retirees to control their tax rate, right? When we're retired, if we're not receiving any other income other than Social Security, most of us are going to get that money from our bank account, right? What I call a tax me as I go account. We're going to get that from a regular IRA or a regular 401k, what I call a don't tax me now, but tax me later, because as we take money out of a regular IRA, a regular 401k, we're going to be taxed, or a tax me now, but never tax me again account, which is the Roth version of those. And by having those 3 buckets, for the first time in our lives, many of us can control our tax rates. And so because taxes are one of the biggest expense for retirees, it's super important that you have a strategy. And for most people, working with an accountant, working with a fiduciary financial advisor is money extremely well spent to come up with that strategy to make sure that you pay no more tax than what you owe. You also want to make sure that you don't work too long, right? The reality is many people are going to save hundreds of thousands and maybe even millions of dollars that they're never going to spend. So deciding when you're going to retire is important. And that's why I made this video up here. Why waiting to 65 to retire might be a big mistake. I'll see you in that video. Bye-bye.